Before the headlines catch up, before the mainstream narrative shifts, before analysts begin explaining what already happened, capital is already moving, quietly, methodically, almost invisibly. And if you look closely at what is unfolding beneath the surface of global markets right now, you will realize that silver is not simply rising, it is being repositioned. This is not speculation. It is not driven by hype, and it is not fueled by emotional storytelling. The data is public. The numbers are verifiable. Reports from Reuters, the Silver Institute, and major financial publications confirm every structural detail we are about to examine. The difference is not access to information. The difference is interpretation. Because when you connect falling Treasury yields, softer retail sales, persistent supply deficits, tightening inventories, and accelerating ETF inflows, a pattern begins to form. And that pattern suggests something far more important than a short-term price rally. As this analysis is being recorded, gold and silver are climbing, while United States Treasury yields are drifting lower, following weaker than expected retail sales data. Mainstream coverage is concentrating heavily on gold, as it usually does, but the more revealing shift is taking place in silver. Precious metals are not rising in isolation. They are reacting to macroeconomic signals that suggest consumer momentum may be slowing. Retail softness sends ripples through bond markets. Yields respond, and when yields decline, the opportunity cost of holding non-yielding assets like silver decreases. Silver is currently trading around $82 per ounce. When this reaches you, the number may be slightly higher or slightly lower. That is not the focus. What matters is the structural backdrop that is supporting price strength. After experiencing a short-term pullback from recent highs, silver rebounded decisively, reclaiming the $80 level per troy ounce. This was not triggered by speculative frenzy or social media campaigns. It reflects macroeconomic mechanics that institutional investors have been anticipating. Softer retail sales indicate that consumer spending may be moderating. Consumer demand is a foundational component of the United States economy. When spending slows, earnings projections adjust. Growth forecasts soften. Central banks observe these developments carefully. Bond yields fall in response. As yields ease, capital rotates. It does not disappear. It seeks assets that can preserve value during uncertain periods. Silver is benefiting from that rotation. The metal is increasingly viewed not as a short-term trade, but as a structural allocation. Volatility remains present, and regional markets respond at different speeds to global signals. But beneath the short-term fluctuations, deeper forces are at work. According to the latest data from the Silver Institute, global silver demand in 2026 is expected to remain broadly stable. Some segments, such as industrial fabrication and jewelry demand, are experiencing modest softness. Under typical conditions, that would weigh on prices. Yet the weakness in those traditional categories is being offset, sometimes more than fully, by a surge in investment demand. Retail investors and institutions alike are reshaping the composition of silver demand. This shift is critical because when investment demand accelerates into an environment already characterized by supply constraints, the imbalance becomes more pronounced. The Silver Institute now projects that the global silver market will record its sixth consecutive annual supply deficit, 6 years in a row. That is not a temporary anomaly. It is not a one-year disruption. It represents a structural imbalance that has been building quietly over time. Years of underinvestment in mining exploration and development have limited the ability to expand production quickly. Ore grades at existing mines continue to decline. Extracting each additional ounce requires processing more material, increasing costs, and limiting responsiveness. Silver is often mined as a byproduct of copper, lead, or zinc operations, meaning production decisions are influenced more by base metal economics than by silver prices alone. This supply inelasticity prevents rapid rebalancing. Meanwhile, in India, silver futures on the multi-commodity exchange recently pulled back to approximately 2.9 lakh rupees per kilogram after a powerful rally. This decline did not signal collapsing demand. It reflected profit-taking, currency effects, and natural volatility following rapid repricing. Markets adjusting to higher valuation regimes frequently exhibit these pauses. Short-term retracements do not invalidate long-term structural conditions. What makes the present environment particularly compelling is that price action aligns with measurable data. Investment demand is not anecdotal. In India, silver exchange-traded funds experienced a dramatic acceleration in January, with net inflows rising approximately 139% month over month. Assets under management in silver ETFs have reached record levels. These inflows occurred even after significant price appreciation, suggesting conviction rather than fear of missing out. Physical market signals reinforce the story. Silver inventories held on the Shanghai Futures Exchange have declined to near 10-year lows. levels not seen since around 2015, when silver traded at dramatically lower prices. Historically, depleted exchange inventories precede sustained upward pressure. When visible stockpiles shrink, the market becomes more sensitive to demand shocks. Buffers thin, elasticity decreases, price discovery accelerates. All of this is unfolding against a backdrop of broader economic recalibration. Precious metals recently pulled back from record highs as traders locked in gains, yet the drivers supporting silver remain intact. Analysts emphasize that the current environment is not fueled by panic narratives. It is driven by an uncommon convergence: declining yields, persistent supply deficits, accelerating investment flows, and tightening inventories. These are not short-term headlines. They are long-cycle dynamics that take years to form. What we are witnessing is not merely a reaction to one data release. It is a gradual reassessment of silver's role within portfolios. The metal is behaving less like a speculative commodity and more like a hybrid asset positioned at the intersection of monetary hedge and industrial necessity. Pullbacks are being met with renewed buying interest rather than sustained liquidation. Dips are viewed as opportunity rather than warning. Volatility is expected during structural repricing. What matters is how the market absorbs it. So far, each correction has revealed underlying demand. Each macro shock has reinforced relevance rather than diminished it. The United States economy is signaling moderation. Retail softness influences policy expectations. Lower yields reduce bond attractiveness relative to precious metals. This relationship has repeated across decades of market history. When real returns compress, capital seeks alternative stores of value. Silver stands at that intersection today. This is not about dramatic predictions or sensational claims. It is about observable shifts. 6 consecutive supply deficits, 139% ETF inflow growth in India, 10-year low inventories in Shanghai, yields declining as economic signals soften. These elements are measurable, they are documented, and together they suggest that silver's current movement is not random noise. It is structural, it is deliberate, and it may represent the early stages of a broader transition in how global capital perceives one of the most overlooked assets in the financial system. Part 2, Version 2, approximately 1,300 words. To understand why this moment in silver feels different from previous rallies, you have to move beyond price charts and examine the structure of demand itself. Silver is not simply a monetary metal like gold. It operates with a dual identity that makes its behavior more complex and, in many ways, more powerful. Roughly half of global annual silver consumption comes from industrial use. That fact alone changes the entire framework of analysis. The solar energy sector has become one of the most consistent drivers of incremental silver demand over the past decade. Each photovoltaic panel requires silver paste for electrical conductivity. As countries accelerate renewable energy deployment, silver becomes embedded in that infrastructure expansion. This is not a distant future scenario, it is current production. Factories are manufacturing panels daily. Installations continue across Europe, Asia, and North America. Governments are subsidizing renewable projects. Corporate sustainability initiatives are expanding. Silver sits inside that growth. Electric vehicles add another layer. Modern electrification demands extensive circuitry, battery management systems, and conductive components. Silver's properties make it difficult to replace without sacrificing efficiency. As the automotive sector transitions toward hybrid and fully electric platforms, silver intensity per vehicle increases. This demand does not depend on speculative enthusiasm, it depends on engineering necessity. Medical applications provide yet another channel. Silver's antimicrobial characteristics are widely used in wound care, surgical instruments, and hospital surfaces. Healthcare innovation continues incorporating silver in specialized coatings and treatment technologies. Telecommunications infrastructure also contributes to consumption. Fifth-generation networks require silver within numerous hardware components, from base stations to consumer devices. As global connectivity expands, so does industrial silver use. Industrial demand tends to be relatively inelastic. Manufacturers cannot simply eliminate silver when prices rise. They may seek efficiency improvements, but the metal remains integral to production processes. That baseline consumption creates a structural floor beneath the market. Now imagine that industrial demand remains firm while investment demand accelerates. The supply side cannot adjust quickly. Tension builds quietly. Investment demand operates differently. It responds to macroeconomic signals. When Treasury yields decline following weaker retail sales data, investors reassess the relative attractiveness of bonds. Lower yields reduce the opportunity cost of holding non-yielding assets. Silver benefits from that mathematical shift. It becomes comparatively more appealing within diversified portfolios. Unlike gold, silver's lower price per ounce makes it accessible to a wider demographic. Retail investors can accumulate meaningful positions without allocating significant capital per purchase. Coins and bars remain popular among individuals who value tangible ownership. The physical aspect provides psychological security in uncertain financial climates. Exchange-traded funds offer convenient exposure for those preferring liquidity and simplicity. The surge of approximately 139% month-over-month inflows into Indian silver ETFs illustrates this shift clearly. Assets under management have reached record levels. Importantly, these inflows occurred after a substantial price increase, suggesting conviction rather than impulsive buying. Investors appear to be reallocating strategically. Institutional interest also plays a growing role. Pension funds, endowments, and family offices increasingly include precious metals within portfolio construction models. Academic research supports modest allocations to metals for diversification benefits. In recent years, stocks and bonds have shown periods of simultaneous decline, challenging traditional assumptions about correlation. Assets with distinct return drivers become more valuable in such environments. Mining supply, however, does not respond rapidly to rising prices. Developing new mines requires years of exploration, environmental approvals, and capital investment. Existing operations face declining ore grades. Extracting each ounce becomes more resource-intensive over time. Furthermore, a large portion of silver production originates as a byproduct of copper, lead, and zinc mining. Production decisions are therefore tied to base metal economics, not silver pricing alone. This structural inelasticity explains why the Silver Institute projects a sixth consecutive annual supply deficit. 6 years of consumption exceeding combined mine and recycling supply signals persistent imbalance. Recycling contributes additional ounces each year, but not at a pace sufficient to close the gap. The deficit must be absorbed by drawing down existing stockpiles. Unlike gold, silver is often consumed irreversibly in industrial applications. Tiny quantities dispersed within electronics and solar panels are economically impractical to recover. Much of the silver mined historically no longer exists in accessible form. This consumption dynamic differentiates silver from other precious metals and tightens long-term availability. Exchange inventories provide a window into accessible supply. The Shanghai Futures Exchange has reported stockpiles near 10-year lows. Similar trends have emerged in other trading hubs. When visible inventories shrink, the market becomes increasingly sensitive to demand fluctuations. Even modest buying pressure can trigger outsized price responses in tight conditions. Currency movements add complexity. A weaker United States dollar typically supports higher dollar-denominated commodity prices. For international investors, dollar weakness lowers local currency acquisition costs. That dynamic can stimulate additional global demand. Conversely, a strengthening dollar may temporarily moderate silver gains. Geopolitical uncertainty reinforces safe haven flows. Trade tensions, fiscal policy debates, and regional instability encourage diversification into tangible assets. Silver participates in this defensive allocation while maintaining exposure to industrial growth narratives. That dual positioning is unusual and powerful. Real yields deserve continued emphasis. Nominal interest rates adjusted for inflation expectations determine true purchasing power returns. When real yields fall toward zero or negative territory, traditional fixed income investments struggle to preserve value. Precious metals historically perform well under such conditions. The present macro backdrop, moderating growth signals combined with declining yields, aligns with this pattern. Technical factors also influence short-term behavior. The $80 level has emerged as a psychological anchor. Round numbers often shape trading decisions. Despite periodic pullbacks, the broader trend has formed higher lows over intermediate timeframes. Volume during correction suggests profit-taking rather than capitulation. Options market activity indicates elevated implied volatility. Traders anticipate continued movement. Volatility is not inherently negative. It reflects recognition that silver sits at the intersection of multiple structural forces. When supply deficits persist and investment flows accelerate simultaneously, price discovery becomes dynamic. The transformation underway in silver markets reflects more than price appreciation. It represents a reassessment of the metal's role within modern financial systems. For years, silver was overshadowed by gold and overlooked by institutions. That perception is shifting as documented data reveals tightening supply and strengthening demand. The convergence of industrial necessity and monetary hedging creates a rare alignment. When economic moderation reduces yields and infrastructure expansion sustains industrial demand, silver operates within both narratives. This duality explains why recent pullbacks have been met with renewed buying interest rather than sustained selling pressure. What we are observing is not a speculative bubble detached from fundamentals. It is a repricing supported by measurable deficits, documented inventory declines, and transparent ETF inflows. markets are adjusting methodically, and if these structural conditions persist, the implications for silver's long-term positioning within global portfolios may extend far beyond short-term volatility. Part 3, Version 2, approx. 1,300 words. When you bring all of these elements together, the larger structure begins to reveal itself. Silver is not rising because of a single headline, a viral narrative, or a temporary surge of enthusiasm. It is moving within a framework shaped by measurable supply constraints, documented capital flows, and shifting macroeconomic conditions. The alignment we are seeing, declining Treasury yields, softer retail data, tightening exchange inventories, and sustained supply deficits, is rare. These forces do not frequently converge at the same time. 6 consecutive years of global supply deficits represent more than a statistical anomaly. Each deficit means that annual consumption has exceeded the combination of mine production and recycled supply. The shortfall has been met by drawing down above-ground reserves. Those reserves consist of bullion holdings, industrial stockpiles, coins, and privately held inventories accumulated over decades. Continuous depletion gradually reduces flexibility within the system. While exhaustion does not occur overnight, persistent imbalance compounds year after year. Silver differs fundamentally from gold in this regard. Gold is rarely consumed. Nearly all the gold ever mined remains recoverable and stored. Silver, however, is frequently dispersed in industrial applications in amounts too small to economically reclaim. Electronics, medical devices, solar panels, and countless other products incorporate small quantities of silver that effectively exit the supply chain. That distinction limits the practical availability of historical production. Exchange inventories offer one of the few transparent measures of accessible supply. The decline in Shanghai Futures Exchange stockpiles to near 10-year lows underscores tightening conditions. These levels have not been observed since around 2015, when silver traded significantly lower. When visible inventories shrink, the market becomes more sensitive to incremental demand. Buffers thin. Price reactions amplify. Futures markets depend on confidence that physical metal can be delivered if required. Although most contracts are settled financially, the system relies on the credibility of underlying supply. If participants begin perceiving that deliverable inventories are constrained, pricing dynamics can shift quickly. Markets do not need complete depletion to adjust. They respond to tightening margins and risk perception. On the macroeconomic side, declining United States Treasury yields following softer retail sales data signal potential moderation in consumer strength. Consumer spending drives a substantial portion of economic output. When retail figures underperform expectations, growth forecasts are reassessed. Bond markets adjust rapidly. Lower yields reduce the relative attractiveness of fixed income instruments compared to non-yielding assets like silver. Real yields remain central to this discussion. Nominal interest rates adjusted for inflation expectations determine true purchasing power returns. When real yields decline toward zero or negative territory, traditional bonds struggle to preserve value. Precious metals historically benefit under such conditions. The current configuration, moderating growth signals combined with easing yields, supports silver's relative appeal. Currency markets also influence performance. A weaker United States dollar typically supports higher commodity prices denominated in dollars. For international investors, dollar softness reduces the local currency cost of acquiring silver. This can stimulate incremental demand from abroad. Currency fluctuations therefore serve as an additional transmission channel linking macroeconomic developments to metal prices. Geopolitical uncertainty reinforces diversification trends. Fiscal deficits, trade tensions, and regional instability encourage investors to allocate toward tangible assets. Silver participates in this safe haven demand while maintaining its industrial exposure. That dual positioning differentiates it from purely defensive assets. Institutional participation has expanded meaningfully compared to previous silver cycles. Pension funds, endowments, and asset managers now recognize precious metals as legitimate portfolio components. Academic studies increasingly support modest allocations to metals for diversification benefits. Recent experiences in which equities and bonds declined simultaneously have challenged traditional assumptions about correlation. Assets with distinct return drivers become increasingly valuable in such environments. Infrastructure supporting silver investment has evolved as well. Exchange-traded funds provide transparent and liquid access. Allocated storage services offer secure physical custody solutions. Commission-free trading platforms reduce barriers to entry. Educational resources allow investors to understand supply deficits, inventory trends, and capital flows more clearly than in previous decades. This democratization of information supports informed participation. Mining equities present leveraged exposure to silver prices for those willing to assume additional operational risk. Rising silver prices can expand profit margins disproportionately due to fixed operating costs. However, mining companies introduce risks tied to management decisions, geopolitical jurisdictions, and geological variability. Royalty and streaming companies offer alternative structures, exchanging upfront capital for future production rights. Each approach, physical bullion, ETFs, or mining shares, carries distinct characteristics. Tax considerations and estate planning issues influence how investors structure precious metals exposure. Physical holdings eliminate counterparty risk, but require storage and insurance. Paper instruments offer liquidity, but depend on custodial integrity. There is no universal solution. Suitability depends on individual objectives and risk tolerance. Volatility remains inherent in silver markets. Price swings can be significant, yet recent pullbacks have been absorbed constructively. Corrections have prompted renewed buying rather than widespread capitulation. The $80 level has emerged as a psychological reference point. Round numbers often anchor trading behavior. Despite fluctuations, intermediate price structures continue forming higher lows. Options markets reflect expectations of continued movement. Elevated implied volatility suggests traders anticipate dynamic price discovery rather than stagnation. Volatility in this context reflects recognition of structural forces interacting simultaneously. The documented 139% month-over-month surge in Indian silver ETF inflows deserves continued attention. India represents one of the world's largest precious metals markets. Traditionally, gold dominated cultural preference. A substantial shift toward silver indicates evolving investor behavior. Given India's population size and expanding middle class, even modest allocation changes generate meaningful global demand. China's investor base is also expanding participation in alternative assets amid adjustments in property markets and broader economic recalibration. Policy shifts have gradually broadened access to precious metals ownership. Hundreds of millions of potential participants entering these markets represent structural demand growth extending beyond cyclical movements. Western investors confront rising fiscal deficits and expansive monetary policy frameworks. Concerns about long-term currency stability influence allocation decisions. Whether those concerns ultimately prove justified is secondary to the reality that they shape capital flows today. The convergence of supply deficits, tightening inventories, falling yields, accelerating ETF inflows, and resilient industrial demand creates a rare alignment. None of these factors alone would be sufficient to sustain momentum indefinitely. Together, they form a reinforcing structure. This does not guarantee uninterrupted appreciation. Markets remain unpredictable. External shocks, policy reversals, or unexpected data releases could alter trajectories. Prudent risk management remains essential. Concentration in any single asset class carries vulnerability. Yet the structural case for silver has rarely been supported by such a confluence of measurable indicators. 6 consecutive annual deficits, 10-year low exchange inventories, 139% ETF inflow growth in India, declining Treasury yields following softer consumer data. These are not speculative claims, they are documented realities. Silver's resurgence reflects a reassessment of its role within global portfolios. It sits at the intersection of industrial expansion and monetary hedging. It responds to consumer moderation, bond market adjustments, and currency fluctuations simultaneously. That complexity gives it strategic significance. Whether prices continue advancing steadily or consolidate before the next move, the forces shaping the market extend beyond daily volatility. Observing these dynamics provides insight into broader financial recalibration. Silver is not simply rising, it is being repriced within a shifting global framework. And when multiple long-cycle forces align in this manner, history suggests that the consequences often unfold gradually, then all at once.